Welcome to the Deep Dive. Today, we're looking beyond the headlines, past the noise of daily financial news. We want to get into the geometry and the psychology that actually drives market moves. If you've ever stared at one of those complex charts, the ones full of lines and bars and weird letters, and wished for a way to make sense of it all, well, this deep dive is definitely for you. Our mission really is to break down the core ideas, the foundational rules like Dow theory, and the main tools that technical analysts use. We're digging into the source material to understand how they think. So, okay, let's unpack this whole approach called technical analysis, or TA.
Right. So technical analysis, at its heart, it's about studying what the market did, past prices, how much was traded, market history to try and figure out where prices might go next. But the really big idea underneath the philosophy is that the market discounts everything.
Okay, hold on. That sounds huge. If
Yeah.
the market discounts everything, what exactly does that mean the technical analyst is, ignoring? What are they actually looking at?
Well, we're kind of ignoring the why. When we say discounts everything, it means all the info out there, economic reports, political news, company earnings, even how traders are feeling, the psychology, it's supposedly already reflected in the asset's current price. So if it's all in the price already, then just studying the price action itself, that should be enough to figure out the trend.
Ah, okay. So that's the big split then between TA and the other main way of looking at markets.
Exactly. That's the core difference with fundamental analysis, or FA. FA tries to nail down the intrinsic value, what something should be worth based on its fundamentals. Technical analysis. It doesn't really worry about intrinsic value. It's laser focused on the market action itself, trying to find the right timing for getting in or out.
Got it. So TA is like the timing tool built on this idea that history, well, it tends to repeat itself, or at least rhyme. Makes sense. Now, if we're going to buy into that philosophy, we really need to look at where it all started. The frameworks that first trying to put rules around this price action stuff. We have to talk about Dow theory, right? The historical bedrock.
Absolutely. Dow theory. Charles Dow and others who expanded on his work way back in the early 1900s. It's basically the grandfather of modern technical analysis. It's pretty remarkable because it laid down the rules for how we even define what a trend is and how we confirm it.
Okay.
I already mentioned the first big idea, markets discount everything. Check. The second key part of Dow theory is about the scale of market movements. Dow said market activity is made up of three kinds of trends all happening at the same time. Different degrees, you could say.
Right. You mean the major, intermediate, and short-term trends, like different waves crashing on the shore simultaneously.
Precisely. You've got the major trend that's the primary, the big one, lasting over a year. It sets the overall direction, bull or bear market. Then there's the intermediate trend. This lasts maybe 3 weeks up to several months. And importantly, these intermediate moves often act as corrections against that main major trend.
Corrections, like pullbacks.
Yeah, exactly. And the sources point out something interesting here, a kind of rule of thumb. These intermediate corrections often retrace about 1/3, so 33% up to maybe 2/3, 66% of the ground gained or lost in the previous leg of the major trend.
Huh, that's quite specific. Okay, so major, intermediate, and the third one.
That's the short-term trend. Think of it as the daily ripples, the noise. Lasts less than 3 weeks, sometimes just a few days.
Okay, so trends within trends. But Dow also talked about the life cycle of a major trend, didn't he? The stages it goes through, especially in an uptrend, a bull market. This is where the psychology really comes into play, right?
Oh, absolutely. A major uptrend, according to Dow, typically unfolds in 3 psychological stages. Stage 1 is the accumulation phase.
Accumulation, meaning buying.
Right. But it's smart buying. This happens when the news is still generally bad, sentiment is low, but the informed investors, the so-called smart money, they see value and start quietly buying from those who are still pessimistic or scared. Price movement is usually kind of sideways, not dramatic yet.
Okay, so the smart folks are getting in early while everyone else is still gloomy. What's next?
Next up is the public participation phase. This is when the economic picture starts looking better, the news turns positive, and the market really starts to move up decisively.
Ah, so this is the part where the trend becomes obvious.
Yeah, this is the meat of the trend, as you said earlier. It's usually the longest phase
Hmm.
where you see the biggest percentage gains. And this is when the media jumps on board, the general public starts feeling confident, maybe even a bit excited.
That feeling of FOMO, fear of missing out, probably kicks in hard here for a lot of people. If the smart money bought during accumulation, this phase must be where everyone else piles in.
It can be, yeah. And that leads directly into the danger zone, the distribution phase. This is basically the mirror image of accumulation.
So selling instead of buying.
Exactly. The smart money who bought low now starts strategically selling their positions. They're distributing their shares to the general public, who are often buying now based on hype and euphoria, thinking the good times will last forever. Prices might still nudge higher, but underneath, things like volume might start to show weakness. Momentum fades. That's the warning sign.
Fascinating. Accumulation, participation, distribution, a whole psychological cycle. Okay, but Dow knew trends could be tricky, right? He built in some checks. How do we know if a move is real or just noise?
He did. He was conscious. Needed confirmation. That brings us to the final key tenets for confirmation. Two really crucial ones.
Okay, what are they? How do we avoid getting faked out?
First, volume must confirm the trend. This is huge. If prices are genuinely rising in an uptrend, you should see trading volume get heavier on the up days and lighter on the down days, the pullback days.
Makes sense. More people enthusiastically buying.
Right. If you see prices shoot up but on really low volume, that's a red flag. It suggests there isn't broad conviction behind the move. It might not last.
Okay, volume confirms. What's the second confirmation point?
The second one is a bit more historical, but the principle holds. Indices must confirm each other. Back in Dow's day, this specifically meant the Dow Jones Industrial Average and the Dow Jones Transportation Average.
The industrials make the stuff, the transports ship the stuff.
Pretty much. The idea was, for a healthy economic uptrend, both should be making new highs together. If, say, the industrials hit a new high, but the transports didn't follow along, that was a warning sign. It suggested maybe the underlying economic activity wasn't as strong as the stock market seemed to think.
That's a really solid framework from way back then. Okay, so we have the philosophy, the history, but to actually use any of this today, we need to get practical. We need the tools, the charts. How do analysts actually visualize all this price data?
Right, the charts are the canvas. The language of TA is visual and revolves around 4 key bits of info for any time period. The open price, the highs, the low, and the close price. The most common way to see all 4 is the daily bar chart. Each bar shows you that day's range and where it opened and closed. Very detailed.
Okay, the classic bar chart, but there are simpler ones too.
Yep. The absolute simplest is the line chart. It just connects the closing prices over time, smooths everything out, gets rid of the daily volatility, just shows you the general path.
Useful for a quick overview, maybe? And then there's that really different one, the one that seems to ignore time.
Ah, the point and figure chart. Yeah, that one's unique. It uses columns of X's when the price goes up and columns of O's when it goes down. Yeah. It only adds a new X or O if the price moves by a certain amount, a preset box size.
So it doesn't matter if it takes a day or a week for that move.
Exactly. Time isn't on the horizontal axis in the same way. It focuses purely on significant price reversals and momentum shifts, filtering out minor fluctuations. Very different perspective.
We should probably also mention candlestick charts quickly. They're super popular now.
Right, good point. Candlesticks show the same open, high, low, close as a bar chart, but they use a real body, usually colored, to instantly show you if the close was higher or lower than the open. Gives you a really quick visual read on the buying or selling pressure for that period.
Okay, lots of ways to view the data. Now, something the sources really stress is the scale you use on the price axis, arithmetic versus logarithmic. Why is that choice so important?
It's critical because it completely changes how you perceive the trend, especially over long periods. The standard arithmetic scale is simple. Every dollar move looks the same size. So a stock going from $10 to $20 looks like the same vertical distance as it going from $100 to $110.
But wait, $10 to $20 is a 100% gain. $100 to $110 is only a 10% gain. That arithmetic scale makes the later, smaller percentage move look just as significant visually.
Exactly. And over decades of data, those recent dollar moves, even if they're tiny percentages, can visually dwarf the massive percentage growth that happened earlier when the price was much lower. It distorts the picture of long-term growth.
So that's where the logarithmic scale comes in, to fix that distortion.
Precisely. The logarithmic scale, or semi-log technically, because time is usually still linear, shows equal percentage changes as equal vertical distances. That $10 to $20 jump, 100%, will look much bigger than the $110 jump, 10%.
Ah, so for looking at trends over years or decades, log scale gives you a much truer picture of the rate of growth.
Absolutely essential for long-term analysis, yeah. Prevents that visual distortion.
Okay, charts, scales. What about other data points? Especially in markets like futures, there's more than just price and volume, right?
Yes, good point. Besides price and volume, which we said needs to confirm the trend, in futures and options markets, analysts watch open interest very closely.
Open interest. That's the total number of contracts still open, not yet closed out.
Exactly. It tells you how many positions are currently active in that market. Rising open interest, along with rising prices, generally suggests new money is flowing in, confirming the uptrend. Falling open interest might mean positions are being closed out, maybe the trend is weakening. It adds another layer of confirmation.
All right, we've got the philosophy, the historical context, the canvas. Now let's nail down the absolute bedrock visual concept. How do we actually define a trend just by looking at the chart? It's all about the swings, right?
Pure geometry, really. An uptrend, a bullish trend, is simply a series of higher peaks and higher troughs. Each rally goes higher than the last peak, and each dip stops at a higher low than the last low.
Okay, higher highs and higher lows. Makes sense. Downtrend is the opposite.
Just flip it. A downtrend, bearish, is a series of lower peaks and lower troughs. Each decline goes lower than the previous low, and each bounce fails to reach the height of the previous peak.
And if it's not doing either, just chopping
Yeah.
sideways.
That's your sideways trend, or range-bound market. Peaks and troughs are basically hitting the same horizontal levels. No clear upward or downward progress.
Okay, defining the trend is step one. Then we layer on these crucial concepts: support and resistance. SR levels. These aren't just random lines someone draws, are they? They represent something deeper.
Oh, definitely. They are visual representations of market memory, crowd psychology etched onto the chart. Support is a price level below where the price currently is, where buying interest was previously strong enough to stop a decline and turn it back up. Think of it like a floor.
Buyers step in there.
Yep. And resistance is the opposite. It's a price level above the current price, where selling pressure previously overwhelmed buying interest and turned prices back down. That's the ceiling.
And why do these levels tend to hold? You said market memory, psychology.
Exactly. Think about it. Someone bought at a price that turned out to be a peak, resistance. The price fell. If it rallies back up to their entry price, what are they likely feeling?
Relief. And maybe wanting to sell just to get out even?
Right. That selling pressure helps reinforce resistance. Now flip it. Someone missed buying at a low support before the price rallied. If the price dips back down to that level, they might see it as a second chance to get in. Their buying helps reinforce support. It's regret, hope, fear, all playing out.
That is a really powerful idea, the market reacting based on past pain points and missed opportunities. And that leads to maybe the most important SR behavior: role reversal. This feels like a key aha moment in TA.
It absolutely is. Role reversal is fundamental. When a significant resistance level, that ceiling, is decisively broken by rising prices, it often transforms. It changes its role.
How so?
That old ceiling tends to become the new floor. Buyers who were stopped by it before now see it as a level of strength. On subsequent dips, they're often willing to buy at that old resistance level, providing new support.
Wow, okay. Resistance becomes support.
And the same thing happens in reverse. When a strong support level floor is clearly broken by falling prices, it tends to become the new ceiling. Well, everyone who bought at that support level is now losing money. If the price bounces back up to that breakdown level, many of them will be desperate to sell and cut their losses, creating new selling pressure, new resistance where there used to be support.
Understanding that switch is critical for figuring out if a trend is likely to continue after a breakout. Okay, last piece for today. The practical tools analysts draw on the chart to actually track these trends and spot potential changes. Trend lines and the fan principle.
Right. Trend lines are probably the simplest, most widely used technical tool. You draw them to quantify the trend. For an uptrend, you connect the lows, the troughs. You're drawing a line underneath the price action.
And for a downtrend.
You connect the highs, the peaks, drawing a line above the price action.
How many points do you need for it to be a real trend line?
Well, you can always draw a line between any 2 points.
Yeah.
But the sources generally say a trend line isn't considered truly valid or confirmed until it's been touched by the price at least 3 times. That third touch adds credibility.
So if price then closes below a confirmed uptrend line or above a confirmed downtrend line, that's a big deal.
That's your first major warning sign. A decisive break of a valid trend line is often the earliest signal that the prevailing trend might be changing. It's not just a normal pullback anymore.
Is there a rule for how much it has to break by to avoid false signals, quick dips below?
Some analysts use filters, yeah. A common one is maybe a 3% penetration rule. Like the price has to close 3% below the uptrend line to be considered a significant break. Or sometimes they look for it to hold below the line for, say, 2 consecutive days. Ways to filter out the noise.
Okay, so breaking the trend line is warning sign #1. What about the fan principle? That sounds like it builds on the trend line break.
It does. The fan principle is specifically a technique used after a primary trend line has been broken. designed to help signal if that break is leading to a full trend reversal.
How does it work? Like drawing multiple lines.
Kind of. Once your main valid uptrend line, let's call it line 1, is broken, you wait for the next minor rally, and you draw a new, steeper trend line, line 2, connecting the original starting point to the low of that first breakdown bounce. If that line 2, is also broken,
You draw another one.
you often draw a third line 3, again connecting the start point to the low of the next bounce after line 2 broke. These 3 lines often fan out. The strongest signal, according to this principle, that the original uptrend has definitively reversed into a downtrend comes when that third fan line is broken decisively to the downside.
Wow. Okay. So it's like a three-strike rule for the old trend, a layered confirmation that things have really changed. All right. This has been quite the journey. We've gone from the core idea that markets discount everything through the structure and stages of Dow theory into the nuts and bolts of charts, scales, support and resistance, role reversal, and finally drawing tools like trend lines and the fan principle. I think for you listening, the most crucial takeaway here is that these concepts, support, resistance, trend lines, they aren't just arbitrary lines. They are visual representations of collective human behavior. They show where buying and selling pressure has shown up before, driven by fear, greed, hope, regret. It's market psychology made visible.
And that brings us right back to that Dow theory life cycle, doesn't it? The 3 stages. If we accept that major trends often end in that public participation phase, followed by distribution, where euphoria often reigns, what does that really tell you? It highlights the absolute need for psychological discipline in trading, doesn't it? Can you really use these tools effectively if you don't have strict rules to stop yourself from getting swept up in the crowd's emotion, especially near the end of a move when the smart money might be quietly heading for the exits? That tension between the chart signals and your own feelings, that's something to really chew on.